Well, it was another week of record highs on Wall Street last week as trade deals continue to be made, including ones between the US and Japan, and over the weekend, the US and the European Union as well. And added to that, of course, you have Trump seemingly backing down on his threats towards Fed Chair Jay Powell. Nevertheless, a bumper week of event risk now awaits, probably the last proper week before we get into the meat of summer markets, as another tariff deadline looms on Friday. The FOMC, the BoJ, and the Bank of Japan are set to decide policy. The Treasury in the United States provide their latest quarterly refunding announcement. We have the busiest week of Q2 earnings season, and not forgetting a packed data docket as well, including the latest US jobs report on Friday. A plethora of things for us to discuss on the trade-off this week. So without further ado, let's crack on with the show. So a busy old week for financial markets last week. This week shaping up to be even busier. Joining me to try and make sense of everything that's going on is my very good friend Ryan Littlestone from Forex Live and Forex Analytics, who I shared a very lovely lunch with in Bournemouth on Friday, which also explains the rather red and rosy complexion that we are both showing off on the trade-off this week. How you doing, mate?
Yeah, morning, mate. Yeah, both look like red cards today. And yeah, no, it was nice to host you down here. We had a lovely lunch, lovely scenery by the sea, and yeah, both got sunburned. So yeah, ticked all the boxes.
Yeah, indeed. I'm just glad you're not wearing that horrible red shirt again today. We wouldn't be able to see where the shirt ends and your head begins, I don't think.
Yeah, so many compliments. You keep slagging off my shirts. Yeah, I keep getting so many compliments. So someone's not right.
Yeah, I think we'll leave that one there before I insult our dear audience once again. And what we will do is we'll move on to safer ground in topical thunder because we have plenty to discuss this week. So lots going on. I'm going to get things started with the FOMC. It's not only going to be a busy week this week for the Fed, it was also a busy week last week, actually. We had those quite farcical and actually a bit, frankly, shameful scenes of President Trump and Fed Chair Powell stood there in suits with white hard hats on, arguing basically in front of the US and international media over the renovation budget. And actually credit to Fed Chair Powell for being, I think, the first government official that I've seen in the last 6 months who's actually stood there and turned round to President Trump and told him that he was wrong with that rather creative accounting that he was trying to do. I mean, to be honest, I think it's ridiculous that Powell is having to put up with this bullying from Trump in the first place. And the fact that that is now playing out in front of the media is just making things even worse. But anyway, the focus, thankfully for us all, is going to turn back to the policy front this week. Despite Trump continuing to call for lower interest rates, he wants rates to be set at 1%. Well, I can assure you, Mr. Trump, that is not going to happen this week. It's probably not going to happen for a number of years. The target range for the Fed funds rate will be held steady between 4.25% and 4.5% this week, although that decision is unlikely to be a unanimous one. We have heard many a time in recent weeks from Governor Chris Waller, who has flagged how he believes the Fed should deliver a 25 basis point rate cut. And you would imagine that he is going to dissent in favour of such a view. There is also the potential that Governor Bowman dissents in favour of a 25 basis point cut as well, although I would note that her rationale for that dissent was much more caveated than that we've seen from Waller. Waller seems much more concerned about the state of the labour market, whereas Bowman was saying that we could deliver a cut if inflation remains low. Well, of course, CPI and core CPI rose to their highest levels since February in the meantime between Bowman making those remarks and the July FOMC. So I think there's potentially a lesser chance that she dissents. Nevertheless, both of those have been relatively well telegraphed, and it's also been pretty well telegraphed that the policy statement is going to be basically a carbon copy of that issued last time out, re-emphasizing that inflation remains somewhat elevated, that the economy is solid, the labour market is solid, unemployment still low, and that the Fed are attentive to risks on both sides of the mandate amid high economic uncertainty. And frankly, Chair Powell is probably going to very much stick to his script at the post-meeting press conference as well. He's certainly not going to be drawn on any of this political nonsense or any of this rubbish around the building renovation. He is going to stick firmly to a wait-and-see approach when it comes to monetary policy. Personally, I think there's two plausible paths that policy could follow as we move through the remainder of this year. After the July Fed meeting on Wednesday, there's going to be three decisions left in 2025, and of course the Jackson Hole Symposium in there as well, which is not a decision, but it's a very good opportunity for the Fed to signal a policy path. The first potential path that they follow is 225 basis point cuts, probably in September and December, and they go down that route if inflation remains relatively subdued and or a degree of slack and weakness emerges in the labour market. And of course, we have the latest jobs figures on Friday, which I know you're going to discuss in a moment, Ryan. So watch that very closely. If they are going to go down that path, it needs inflation to remain contained, and they could signal a pivot at Jackson Hole. That's not my base case, though. My base case is that we probably get just one rate cut this year, 125 basis point cut, and most likely we're going to have to wait until December for that to be delivered, assuming that the tariff-induced price pressures continue to bubble away and continue to push inflation higher over the next couple of months. As long as the economy and the labour market remain resilient, then there is not really any need for the Fed to be doing anything, despite the ongoing rants from the man in the Oval Office. And the market currently prices about 44 basis points worth of cuts by year end, so there's 20 odd basis points of room to trade that view if you are so desired.
Oh, where do we start with this one? Firstly, that oh, I can't swear. That show last week. I mean, it was hilarious. I mean, it's probably some of the best TV I've watched in years. Trump and Powell going at it, particularly when Trump pulled his bit of paper out and Powell was scrutinising over it. It was typical. Everyone's pulled that face when we've had a quote from the builder. That's $1 billion out of what you're expecting. But yeah, aside from that, I mean, there's something that we've been watching and listening to. Obviously, Waller's been banging on about rate cuts to the point where we've said, well, then he should be dissenting at the meeting. But then he came out, I think it was early last week, and said, well, it's not certain that I will dissent at the meeting. So it's like, well, are you going to put your money where your mouth is or not? And, you've got these people, and we said it's going to all become political. People like Waller putting his name up for the job, wanting to make the comments that Trump wants to hear. But again, if you're not going to back that with action, then what's the point? No, a dissent doesn't really matter. But if you feel that strongly, then you vote that way, or you put your name that way. As for the rest of it, yeah, it's the FOMC itself. It's more probably going to be if we get any clues about whether they're going to cut and when they're going to cut next. But if it is a carbon copy of the last statement, then everyone's going to sail off into the sunset and their summer holidays again.
Yep, absolutely. And then we reconvene at Jackson Hole, I believe, on the 21st of August and see where things stand then. Because, of course, in the meantime, we will have had, one jobs report, we'll have had the PCE numbers, we'll have had the July CPI data, which should show an uptick. And we may also, I suppose we can dream, but we may also have some greater clarity on the tariff front as well. But it's not just the FOMC on deck this week. You have the rather unfortunate task of going through everything else that's going on.
Yeah, that's right. Well, before we move on, I did want to talk about quickly about 10-year yields.
Oh, sorry.
Over the FOMC, but no, you're obviously in a rush this morning. But
well, you were the one hurrying me up for being late, so I'm,
you were late. So don't get me. Let me get the cards out again. So yeah, I mean, if there's one trade I was going to be looking at for the FOMC, it was 10-year yields, and just briefly, I've been talking about this before. We're walking in this range between 420 and 450. We're just above a sort of pivot level around the 434 mark. So if you are looking for a potential trade over the Fed, if it's quiet elsewhere, any moves to the edges of those ranges are probably worth looking at for an opportunity.
Yes, and also on the 30-year yield as well, similar. We've been between that sort of 4.70 and 5% for God only knows how long now. And again, towards the back end of last week and on Friday, we saw dip buyers coming in at that 5% mark. So potentially one to watch there as well. Sorry, mate. Now you've got that off your chest. Shall we move on?
Yes, certainly. Thank you very much, mate. It's going to be a stonking week of events this week. So I've picked really the choice events to watch, the ones that might bring a bit of trading volatility. Firstly, we've got all the central banks. We have the BOC, which is expected to come in unchanged on Wednesday at 2.75%. The Bank of Japan on Thursday expectations are for the rate to be kept on hold. No expectations at all for them to change the rate. But like the ECB last week, we're looking for signals for what they might do for the rest of the year. That's probably the most important aspect from that. Now, there's already been some stories that the BOJ may still see a hike in them later this year, and especially if we've got over this trade and tariff hump, and that uncertainty is lifted enough. More importantly, it is a forecast meeting, so watch the updated forecast as their inflation projections are rumoured to go higher, albeit down to cost push pressures, which is this temporary thing they keep talking about, like rice prices. So it could be inflation going up, but not the right sort of inflation. We've also then got the key data points this week. Got US consumer confidence on Tuesday. We need to see whether sentiment there continues to bounce back, a bit like we've seen in the Michigan numbers. We've also seen there that inflation expectations have fallen back. So that's what we'll be looking at closely in those numbers. It's CPI and GDP data this week in Europe and elsewhere. And the inflation numbers there will be important for when the ECB may cut next, especially after last week's meeting, where the market was pretty much wiped September off the calendar in terms of when they might make their next move. Now, in the US, we get the first Q2 GDP numbers as well, ahead of the Fed, followed by PC on Thursday, which now seemingly every Fed head is coming out and giving their forecasts for.
I'm moaning about this.
I'm always going to have a moan. Now, one reason for this is that people are saying that once you get the CPI and the PPI data and know all the components, it's easier to make a guess. The general view from them is that PC is going to come in higher, around 2.5% from the 2.3% we saw last month, and the core between them 2.7, 2.8% versus 2.7% previously. So they are there looking for another little jump in inflation. Friday is obviously NFP day. We're expecting around the 105, 110,000 mark from the 147 we saw last month. The unemployment rate is expected to tick up to 4.3% from 4.2, but watch that participation rate because that can affect that unemployment rate. As always, keep an eye on the government and private payroll split in case we see any shenanigans like we did last month. Government payrolls actually made up half of last month's figure, and we're closing in on the time when the Doge cuts might start showing up, which obviously is one of those known unknowns that could cause a wobble. After that comes ISM manufacturing, and finally, don't forget it's end of month too. So all in all, lots to digest, and I'm actually half happy I'm away for it.
Yeah, I was going to say you've timed your holiday impeccably there, mate, with all of this going on, and then you're going to come back next week, and it's a completely barren calendar apart from the BOE. Where the hell do we start with that lot? I mean, let's just go in reverse order. I think the jobs report is going to be interesting. I'm not expecting much by way of surprises there. I think the Doge one is interesting because obviously most of those sort of contract buyouts ran until September. So we're still a couple of months away from the full impact of that coming through. The risk, though, is, of course, that the June jobs number, that was largely propped up by hiring in state and local government and potentially some seasonal adjustment with teachers of all things. So if that begins to unwind, then we're really asking the private sector to pick up the slack there. But I certainly don't think there's going to be enough by way of weakness to force the Fed into any action, at least not with inflation starting to bubble away once more as well. In terms of here in Europe, not expecting any huge surprises in terms of CPI. That's going to remain as close to the target as makes no difference at a headline level. GDP, that's going to be very messy on both sides of the Atlantic, but in different directions. Of course, Q1 was skewed lower in the US and skewed higher in the rest of the world because everyone was rushing to get imports into the US before the tariffs went in at the start of April, as it was going to be back then. Of course, that front running is now going to unwind in the Q2 data. So that's going to be a drag in the rest of the world and a boost in the United States. So don't read too much into any of that. And then in terms of those central bank decisions, the BoJ, they've just managed to get trade uncertainty out the way, and now they've got a dollop of political uncertainty to deal with. Will Ishiba stay? Will he go? It looks like he's on borrowed time, to be honest with you, so that will probably keep them on the sidelines for a bit longer. And the Bank of Canada, well, they are probably on hold for the time being. I don't think the market price is much there, but of course also they have tariffs to potentially worry about from Friday. Will they go in or will they not? So yeah, plenty of moving parts, and I think we'll all be glad of a lie down come about 3:30 Friday afternoon once the ISM manufacturing survey is out.
You're going to be here that long? Usually you're done 3:05 on a Friday afternoon.
Oh, well, maybe 10 past I'll stretch it to this week.
It's all a favour.
Moving on. I mentioned the issue of trade. Of course, we have yet another tariff deadline looming this week. Of course, the Liberation Day tariffs that came in, or were meant to come in at the start of April. They were then kicked down the road to the beginning of July. Well, the pause on that expires this week on the 1st of August. That is the deadline when countries that do not have a trade deal with the United States are, as I speak, and it's currently 9:20 Monday morning, so this could change by the time you watch this video, they are due to see their tariff levels ratchet back to the levels that were outlined in letters at the start of the month. So 30% on Mexico, 35% Canada, I think 25% South Korea, etc., etc., etc. We are also due to see a 50% tariff on copper imports go into effect on the 1st of August as well. Now, I would just caution on this. There was an interesting line from Trump over the weekend, who said that they will be sending, and I quote here, confirmation letters to countries this week. Now, maybe that confirmation will just be a cut and paste of what was sent at the start of July. But again, it just says to me there is room for negotiation. There's room for that tariff to come lower. There's room for the 1st of August to become Labour Day, as Treasury Secretary Scott Bessent has been touting in the past. And he even last week was talking about a focus on high quality deals as opposed to just a number of deals being done before the 1st of August. So still lots and lots and lots of moving parts on this one, and by no means even 4 days out is that 1st of August deadline set in stone. And in fact, the broader direction of travel is still towards trade deals being done. It is still towards calmer heads prevailing. Last week we had news of a US-Japan trade deal. We also had US-Indonesia and US-Philippines being done. And then, of course, over the weekend, the big one, the US-EU trade deal was done with a 15% tariff on EU imports. Importantly, including European autos, which have been a big risk for the sector. The European Union committing to buy almost $1 trillion worth of US energy and an extra $600 billion worth of investment in the US as well. But slowly but surely, those sort of tail risk no deal outcomes seem to be getting taken off the table. And again, speaking to that, we have US-China trade talks taking place in Stockholm today and tomorrow, and it's highly likely that they agree another 90-day extension to the current trade truce. So the base case is that, frankly, we're just going to get the can kicked down the road once more. But I would just caution, treasuries are kind of calm-ish. The FX market has fallen asleep and stocks are trading at all-time highs. So there is, I would say, potentially a bigger risk now than there probably was at the start of July, and certainly than there was in mid-April, that actually Trump goes, well, the markets are fine, so why don't I follow through this time? It's certainly not my base case, but do just bear in mind that as the week drags on, if we do end up in a bit of a kind of information vacuum or void, and there's still this lack of clarity as to what's going to happen on Friday, then I do think that could start to pressure sentiment a little bit as the week goes on. I think equities are still a buy on dips, but just in the short term at least, it could be a case of no news is actually bad news in terms of risk sentiment, particularly as we inch towards that deadline on Friday.
Yeah, I think it's going to be an interesting one, but I'm going to slightly take the other side, because first and foremost, if you look at it, all the big deals are, give or take, signing on the dotted line, getting done. Japan, that's a big one. Europe, that's a big one. China, yeah, we might get a 90-day can kick, but they're still working towards a deal. I mean, with the greatest respect to these countries, no one in the real market gives a monkeys about whether Papua New Guinea gets another letter and whether it's
People are
tariffs
taking you
or
off their
whatever.
Christmas card list now, Ryan.
Yeah, well, you're off New Zealand, so I'm going to your neighbours. But you know what I mean. It's the market's really focusing on the big economies.
Yeah.
And Canada and Mexico are still in the mix, so that may still end up being a bit of a crunch point for both those currencies. Although that situation there is different as well because they've got the USMCA to go through as well. So how much are they going to do on this part of the deal when maybe if they have been negotiating? Trump said previously, or Bessent said previously, anyone who's negotiating in good faith could get an extension. So that all might get rolled into the same parcel, and that'll be another can kick. And I think if there's no big negative headlines from all this, then I think the market's slowly going to move away from the trade stuff unless it all blows up again. So, as I say, if smaller countries get all these letters, 35-50% tariffs, I don't think the market's going to pay that much attention to it. It's been interesting to see what's happened with the euro since all that trade deal was announced. We've seen the euro coming off quite a bit this morning. I don't know if that's the market saying it's not such a good deal for Europe compared to, say the UK's only got 10% tariffs on as their baseline, or whether this is just a reversal of what we've seen where the market getting out of the US. Are we now perhaps starting to see players going, well, we're getting over this hump. Trump's getting his deals done. The economy's not doing too badly. Were we a bit too fast in exiting out of the US? And we're seeing a bit of reversal on that. So price action wise, it's going to be interesting to watch how it's playing out and why we're seeing this move that we are today.
Yeah, no, that's a good point on the euro. Actually, I wonder whether there's a bit of sort of buy the rumor, sell the fact going on in that one as well. It's also month end, so that could be clouding the picture somewhat before you give me a yellow card for saying that. There are still plenty of moving parts. I completely take your point on those sort of big deals. EU, Japan, China, let's just kind of say that they're done for all intents and purposes. There are still some biggies out there. India, they look to be struggling. South Korea is another one, big in terms of electronic exports, and the Canada-Mexico situation, depending on the USMCA exemptions. But there's also the sectoral tariffs. Obviously, copper going on later this week. Lutnick was talking about pharma in 2 weeks' time. They'll have an announcement. Chips, we don't know what's going on there. Plenty of moving parts, but it does feel like the tail risks are being taken off the table one by one, which is naturally a positive for markets. Anyway, let's move on to a little bit of trading wisdom.
Well, I'm going to try with a bit of trading wisdom, but we're entering summertime, and it can be a bit of a funny one for markets because we tend to see volatility dipping, particularly between data points and different events. And once this week is over, we will be well into summer trading. Now, this can be one of the most frustrating times for traders because if markets sort of lock up, finding a trade can be very tough. Now, for me, the key to summer trading is to accept that we're going to get quieter conditions, and we are likely to face that going on for a couple of weeks, probably up until Jackson Hole at the very least. And then you need to look at that and find the strategies that can take advantage of those conditions. That often means practicing a lot of patience and to not go chasing trades. So while big liquidity players will likely be trading less, and that's what takes away the liquidity, watching the option vols can be an important tool. This can help you identify implied movements over data points and give clues about intraday ranges. So if the option market is sort of only implying a 40 to 50 pip daily range for the euro, then no, they will be active if we're pushing the edge of those ranges. It looks like Michael's already disappeared for the summer, so I'll just continue as is unless he wants to come back. One strategy I often implement in these moments is to focus on the bigger, wider levels and sit back to see if they get tested. There's plenty of setups like that in many assets, so take the time to identify them and set alerts. That way, if things are quiet, you can go and do something else, and you only need to take a look when an alarm goes off. Doing that is very helpful if you are super impatient, particularly. For trading's sake, we still have the orange one to keep us on our toes, so hopefully that will keep the volatility up. But please try to practice your discipline. and only pick trades that tick all your boxes, not just half of them. And then hopefully Michael's going to reappear as if by magic.
Right, well, let's crack on with our plays of the day. 2 UK-centric plays for you this week. I'm going to be looking at the equity space, and namely the FTSE 100. Now, I'm fully aware that by me doing this, I'm probably going to be jinxing the recent rally that the market has enjoyed, but I'm going to do it anyway and go long the FTSE 100 for my play of the day this week. The benchmark is trading to fresh record highs north of 9,100 for the first time ever, and we've now notched 5 straight weekly gains. So the momentum is clearly with the bulls, and as we often say around here, there are few signs more bullish than an equity market that continues to print fresh record highs, particularly when you consider how cheap some of the valuations in the FTSE 100 are as well. Now, obviously, a weaker pound will continue to help things along here, and the economic outlook remains pretty dour, which should continue to pose some headwinds to the quid. And just to be clear on that, this is not a bet on the macro situation here in the UK improving anytime soon. For those who are unaware, the vast majority of the FTSE 100 earn the vast majority of their revenue overseas. So this is more of a pure equity play than anything else. And in fact, if you did want to limit the risk on the trade a little bit, then a long FTSE 100, short FTSE 250 spread could actually be a decent way to do so, but also maintain the same overall theme. So here's hoping I've not put the kibosh on the rally that we're seeing in the London market. Ryan, you're looking at Euro Sterling.
Yes, I've had an itch to be long Euro Sterling for a few weeks now, and have been looking for a decent pullback to get in, but we haven't had one, and I don't like chasing the price higher. My reasoning is that I see no good news on the horizon for the UK economy and the political mess that's getting even worse. Now, I'm not one of those UK perma bears that's all doom and gloom every day, but this is probably one of the most bearish I've been on the UK for many years. So I finally had to scratch that itch last week and jump in with a small buy at market, which was at 86.78. Now, as this is supposed to be a play for this show, I still think there's merit in buying up here if we were to pull back to the sort of 8700, 8720 area, which, funny enough, we're doing right at this very moment. And if that area holds, that's where I'm going to look to add to my position. And it would have been sort of the play were I flat and looking to start the trade, this area, 8700, 8720. Now, this is a trade I'm looking to sit in for a while if it plays ball and over the months ahead, just to see how bad things are going to get.
Good stuff. That's actually a view that I would agree with. So do with that information what you will. In any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining us. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as always. And apologies for my slightly mysterious disappearance halfway through. Someone is about to go and be battered with a laptop over their head a few times. In any case, I hope you've enjoyed this episode of The Trade-Off. If you have, do leave a comment, drop a like on the video. Let us know how you're trading the markets, or if there's anything you'd like us to discuss in the show next week. And that is when we'll be back, hopefully bronzed as opposed to red in the face, with another episode of The Trade-Off. In the meantime, have a very good week ahead. We'll speak to you then. Goodbye for now.